Most people are about to lose a massive amount of money, and most of them will not even realize how it happened. That is where I want to begin, because when people hear the phrase once-in-a-decade opportunity, they usually imagine something pleasant. They imagine some clean, obvious moment where the door opens, the light gets brighter, and everyone can see exactly where to walk. That is not how real opportunity shows up in markets. Real opportunity usually arrives disguised as confusion, fear, falling prices, and headlines that make sensible people want to do absolutely nothing. That is why most people miss it, not because they are stupid, not because they do not work hard, not because they lack ambition. They miss it because their instincts are designed to keep them safe in the wrong environment. When prices fall, the human brain reads that as danger. When the news gets darker, the human brain looks for shelter. When everybody around you is saying, wait, be careful, do not move yet, it feels wise to pause. And that instinct, while deeply human, is exactly what separates people who merely survive downturns from the people who use them to build real wealth. Every major recession, every crash, every financial panic in modern history has produced the same two groups. The first group froze, pulled back, waited for safety, and by the time safety returned, the prices had already recovered, and the easy gains were gone. The second group understood something the first group did not. They understood that a financial crisis is not only a period of destruction, it is also a period of repricing, a period when assets get marked down far more violently than their long-term value deserves, a period when fear sells the future at a discount to anybody who can still think clearly while other people are panicking. That is the group that comes out richer, not because they guessed, not because they got lucky, because they understood the cycle. And I believe we are in the early stages of that exact kind of window right now, not at the end of it, at the beginning of it. That distinction matters, because the greatest mistake people make is assuming the opportunity will still be there once the environment feels safe enough for them to act. It will not. By the time it feels safe, the sale is over. That is why I want to walk you through what is really happening right now, why so many people are going to misread it, what is actually on sale, and what it means to approach a period like this the right way. Let me start with the real reason most people miss these windows: fear. Not fear in some theatrical sense, fear in the ordinary practical sense, fear of losing more, fear of being wrong, fear of buying too early, fear of looking foolish, fear of watching the account go lower after you finally do something. That is what really stops people. It is not a lack of information. It is not a lack of access. It is emotional timing. People wait for their emotions to give them permission to buy. The problem is that your emotions are usually most comfortable when the price is already much higher. That is why so many people never build serious wealth. They keep trying to buy confidence. The market only sells confidence at a premium. The cheaper thing is uncertainty. The expensive thing is comfort. That has always been true if you study long-term market history. One fact appears again and again: the best days in the market tend to cluster around the worst periods in the market. They do not show up cleanly after the fear has fully passed. They show up inside the fear. While the headlines are still dark, while people are still shell-shocked, while ordinary investors are telling themselves they will wait just a little longer. That is why missing only a tiny handful of major up days over a long investing lifetime damages returns so dramatically. The market does not politely notify you after the panic is over and invite you back in at the same price. It trades violently and leaves the hesitant behind. So when people say, "I will just wait until things settle down," what they often mean is, "I will pay much more later so I can feel less stupid." Now, that is not a strategy. That is emotional outsourcing. Now, let us talk about how we got here, because if you do not understand the path of the last few years, you will not understand why assets are on sale now. When the world shut down in 2020, the policy response was astonishing in scale. Governments spent, central banks printed, rates were crushed to the floor, money flooded into the system at a pace that would have sounded absurd in earlier eras. The short-term goal was survival. Stop the collapse, keep businesses alive, keep the credit machine functioning, keep households and markets from spiraling into a deeper panic. In the short term, it worked, but massive intervention always leaves a bill, and the bill arrived through inflation. That part was not mysterious. If you create far more money while supply chains are broken and productive capacity is constrained, you get more dollars chasing scarcer goods, prices rise, the purchasing power of money falls, then the central bank has to respond to the inflation problem it helped intensify by making money more expensive again. That is the world we have been living through. Rates rose at a historic pace. Borrowing got more expensive. Easy money valuations stopped making sense. Speculative assets got hit. Unprofitable companies got hit. Crypto got hit. Long-duration growth got hit. Bonds got hit in ways many ordinary investors were not emotionally prepared for because they had been taught that bonds were simply the safe part of the portfolio, not an interest, rate-sensitive instrument that can also suffer badly when the regime changes. And here is the crucial point. What most people experienced as pain was beneath the surface. Repricing assets were going on sale. Not every asset, not every company, not every market, but enough of them. That is how this always works. When capital is too cheap for too long, almost everything gets lifted. Good assets rise, mediocre assets rise, garbage rises. The market stops making hard distinctions because liquidity makes everybody look smarter than they are. Then the liquidity regime changes and the distinction returns all at once. That is what creates opportunity. The same fear that punishes the weak also drags down the strong. That is the part you need to learn to see. When prices are falling, people lump everything together emotionally. They stop asking, what is this worth over 5 or 10 years? And start asking, how fast can I make the discomfort stop? That is how quality gets sold with trash. That is how good businesses end up trading beside bad ones at discounts they would never see in calmer conditions. Think about it in the simplest possible way. If your favorite store cut prices by 30% or 40% on the exact items you already wanted, you would not walk in and say, this is terrible, things are cheaper. You would understand that the value did not disappear simply because the sticker changed. In markets, people lose that instinct because falling prices feel accusatory. They feel like information. They feel like the market must know something you do not. Sometimes it does, sometimes it is just fear. And the skill is learning the difference. That is where the opportunity is. Not in buying anything that is down, not in worshiping lower prices as if all price drops are gifts. Some things fall because they deserve to fall. Some things were absurdly overpriced and are still overpriced after falling 40%. Some companies never had a real business under the valuation story to begin with. You do not build wealth by buying collapse indiscriminately. You build wealth by buying durable value when temporary fear gives you the chance. That is why I keep returning to quality. A good business with real earnings, real customers, real cash generation, real competitive strength, and a price that has come back to earth is different from a speculative business that only looked compelling because money used to be free. The market does not always honor that distinction in the short run, but the longer the horizon, the more that distinction dominates everything. Let me break this opportunity into 3 areas because I want to keep it grounded. The first is the stock market. This is still the simplest and most powerful wealth building machine most people will ever have access to. But the way most people use it is sloppy. They think of the stock market as a giant emotional scoreboard instead of a place where you can buy ownership stakes in productive businesses and hold them while time and reinvestment do the hard work. The real opportunity in stocks right now is not magical. It is that valuations in many areas are no longer insane the way they were when money was free and every growth story got priced like destiny. Certain sectors are carrying much more reasonable assumptions. Now that matters when you buy an asset, your return is shaped not just by the quality of the asset but by the price you pay. People forget this because bull markets make price feel irrelevant. It is not irrelevant. Price is one of the most important parts of future return. That is why Warren Buffett's line about being fearful when others are greedy and greedy when others are fearful remains so powerful. It is not a slogan about mood. It is a statement about pricing. The crowd usually prices things worst when it is emotionally most confident or most afraid. In periods like 2022 and after, when broad repricing hits, strong companies get pulled down along with the speculation that deserve to be crushed. That is where disciplined buying matters. I am not talking about heroically buying the most volatile thing you can find. I am talking about steadily accumulating broad diversified exposure and selectively owning quality businesses that still make sense when you run them through real-world assumptions rather than fantasy assumptions. That is why dollar cost averaging matters so much. It is not just a tactic for beginners. It is one of the simplest ways to defeat your own emotions. Instead of needing to decide every month whether this is the perfect moment, you remove that burden from yourself. You buy on a schedule, you buy through good headlines and bad headlines, you buy when the market is up and when it is down. Over time, that discipline means you automatically buy more shares when they are cheaper and fewer when they are expensive. That system is boring. It is supposed to be boring. Wealth building is often the art of doing boring things long enough that the result stops looking boring. If you look at the long run of broad American equity returns, you are not looking at a straight line. You are looking at a succession of recessions, panics, bubbles, wars, tightening cycles, crashes, recoveries, policy mistakes, and reversals. And yet, across those decades, the disciplined long-term investor who kept buying through the cycle still came out ahead in a way that is almost hard to appreciate until you run the numbers. That is the point. The point is not that there is no pain. The point is that the pain is often the entry fee to the best periods of compounding. The second area is real estate. Now, this one is more complicated because real estate moves more slowly than stocks and is much more sensitive to financing conditions. During the years of ultra-low mortgage rates, housing got pulled upward by a level of affordability that no longer exists. Then rates jumped and the monthly payment on the same house changed so dramatically that affordability got crushed even before prices fully adjusted. That created the strange market we are in. Now, prices in many places did not fully collapse because supply remains constrained and many existing homeowners are locked into low-rate mortgages they have no interest in giving up. At the same time, transaction volumes fell because buyers cannot easily make the math work at current prices and current rates. That is not a healthy equilibrium. It is a frozen one. And frozen markets do not stay frozen forever. What matters here is not whether housing is universally cheap right now. It is not. What matters is that when financing conditions normalize, even partially, demand that has been forced to sit out reappears quickly. People waiting on the sidelines now are not disappearing permanently. They are delayed demand. That means the people who can buy sensible properties and make the numbers work in an ugly rate environment are not just buying property, they are buying the volatility, they are paying the emotional and financial price of doing something difficult while others wait for easier conditions. And when conditions do ease, those easier conditions often arrive alongside stronger demand, which means the reward for buying early belongs to the people willing to act during the uncomfortable stage, not the comfortable one. That is the recurring pattern. I am not saying go buy anything with a door and a roof. Real estate can be just as stupidly priced as any stock market bubble. I am saying that in periods when financing stress creates paralysis, the disciplined buyer who does the math correctly and does not rely on fantasy assumptions is often setting up the next 10 years while everyone else is trying to figure out whether now is a terrible time. The third area is your own earning power. And in many ways, this is the most underappreciated area of all because people want to talk about investments without talking about the machine that funds the investments. For most people, the greatest wealth-building asset is not a stock or a house or even a retirement account. It is their capacity to earn. If you improve that capacity, you improve everything that sits downstream from it. Higher earnings create higher savings. Higher savings create higher investment contributions. Higher contributions compounded over a long period create the kind of financial life people mistakenly think came from one brilliant investment call. This is why downturn periods can be such powerful moments to invest in your own skills. While the crowd becomes fearful, distracted, and defensive, the person who becomes more valuable to the market is quietly changing his entire future. Skills tied to revenue, efficiency, technology, decision-making analysis, persuasion, communication, and implementation matter enormously in a tighter economy. When companies become more selective, they do not suddenly stop valuing people who can solve real problems. If anything, they value them more. And because most people underinvest in themselves when things feel uncertain, the return on doing so can be enormous. It may not feel like a market opportunity in the traditional sense, but it is the opportunity to improve the engine that will fund every future investment decision you make. Now, all of this sounds clean in theory. The real difficulty is not understanding it. The real difficulty is living it. That is where psychology enters the picture, because the biggest enemy in windows like this is not the market. It is your own brain. When you watch prices fall, your brain does not say, excellent, I am buying future returns at a discount. It says, danger, stop, protect, delay. Wait. That is not because you are weak. It is because human beings are wired to experience losses much more intensely than they experience gains. A falling portfolio does not feel like a neutral statistical event. It feels like a threat. Your body reads it like a threat. That is why people sell at the wrong moment and call it prudence. It is also why the solution is not to rely on heroic willpower in the middle of the stress. The solution is to create a system before the fear arrives. Automate your investing, write down your principles, define the kinds of assets you buy and why. Decide in advance what you will do during a drawdown. Build a framework strong enough that when your emotions get loud, the framework is louder. That is how serious people operate, not by pretending they do not feel fear, by designing around it. If you study every major crash of the last half-century, you see the same pattern repeat. Prices fall, fear surges. The crowd assumes this time may be different in the wrong direction. A smaller group either keeps buying or at least refuses to sell what they should continue owning. Then the market recovers often faster than the frightened group expected, and the gains belong disproportionately to the people who were present during the worst emotional period. That is the hard truth. The market does not compensate you for feeling comfortable. It compensates you for enduring discomfort intelligently. That is the difference between panic and discipline. Now, I want to say something about taxes and account structure, because this is one of the places where ordinary people leak an astonishing amount of future wealth without realizing it. Tax-advantaged accounts are not a technical side note. They are one of the greatest legal wealth-building tools available to regular people. If you can put money into a retirement structure where the growth compounds tax-free or tax-deferred for decades, you are giving every invested dollar a much more powerful runway that matters even more. In periods when prices are lower, because the extra shares you buy at those lower prices are now compounding inside the most favorable structure you have access to, and if your employer offers a match and you are not capturing all of it, you are not merely being inefficient. You are refusing free money. That should be fixed before almost anything else. Then there is the question of bonds and fixed income. For most of the period from 2009 to 2022, bonds were a miserable source of real return. Yields were so low that many people stopped thinking of them as an investment and started thinking of them as a form of polite stagnation. But when rates rose sharply, something changed high. Quality bonds and treasury instruments started offering yields that people had not seen in years. That matters because a balanced wealth building plan is not just about maximum upside. It is also about having a structure that allows you to stay in the game through different environments. For conservative investors, or for the safer part of a diversified portfolio, the fact that fixed income again offers meaningful yield is a real opportunity. Not because you should abandon equities, because you no longer have to choose between reckless risk and zero income in the defensive part of your portfolio. That is a gift from the repricing, a painful gift, but a gift. And that is a useful way to think about the entire moment we are in. The last few years have repriced nearly everything: stocks, bonds, housing, affordability, speculation, expectations. It has been painful. But repricing is what creates the opportunity. Without repricing, everything stays expensive and your future returns stay mediocre. So when people ask whether now is a good time to build wealth, I think they are asking the wrong question. The better question is this: are we closer to the beginning of a long period of better entry points and more rational pricing than we were a few years ago? I think the answer is yes. Are we in an environment where fear is elevated enough that many people will make avoidable mistakes? Absolutely yes. Does that combination tend to create opportunity for patient, disciplined investors? History says yes again and again. What I want you to understand is that building wealth during a downturn does not require brilliance. It requires a few much simpler things: a willingness to start before conditions feel perfect, a system strong enough to keep investing when the headlines get dark, a preference for quality over noise, a long enough time horizon that a bad quarter does not become a bad decision, and the humility to accept that you will never catch the exact bottom and do not need to. That last one is important. A lot of people stay frozen because they keep imagining the perfect entry. They do not want to buy now if the price may be lower next month. That is a Child S version of investing. The goal is not to buy the exact low. The goal is to buy meaningful value before the crowd has fully repriced it upward. Again, that is a very different standard, and it is the standard that actually builds wealth. So let me bring all of this together. We are in a period where fear is elevated, prices are more rational than they were during the easy money bubble, and several major wealth building assets are either already on sale or moving toward much better terms than investors had access to a few years ago. That is not a reason to panic, it is a reason to pay attention. The opportunity right now lives in quality equities bought systematically and held for the long haul. It lives in real estate opportunities where the buyer can make today's hard conditions work and position for tomorrow. Easier ones. It lives in your own earning power because the ability to generate more capital remains the foundation under every investing strategy you will ever use. It lives in tax-advantaged accounts that turn ordinary discipline into extraordinary long-run outcomes. It lives in understanding that discomfort is not always a warning to leave. Sometimes it is the price of admission. Most people are going to miss this window. They will miss it for ordinary reasons. They will wait until it feels safe. They will underestimate the speed of recovery. They will overestimate the importance of one bad headline. They will tell themselves they need more certainty. And by the time certainty arrives, the assets will be more expensive, the easy gains will be gone. And they will once again convince themselves that wealth building belongs to someone else. It does not. Not if you understand the cycle, not if you build the system, not if you are willing to act before the emotional part becomes comfortable. This is the kind of window that can change a life. Not overnight. That is another fantasy people need to abandon. Real wealth is rarely built overnight. It is built when somebody makes a correct set of decisions during the uncomfortable phase and then lets time do the compounding. That is what is in front of people right now. The question is not whether the window exists. The question is whether you are going to walk through it while it is still open.